Everybody wants to retire. Everyone wants to quit their job. Everyone wants to live their life doing whatever they want, not have something that they have to get up and go to and do every single day. They want to retire. 20-year-olds want to retire. 65-year-olds want to retire. But what if you retire and the unthinkable happens? What if you run out of money? What do you do then? The idea of running out of money in retirement keeps a lot of people up at night. Not me, I sleep like a baby. But it keeps a lot of people up at night because it's the unthinkable. You plan, you invest, you diversify, you retire, you stop working, and you run out of money. Either you didn't know how much you would really need, or you just went through it. You spent it. Maybe you didn't realize that you would live as long as you did. I mean, you don't know how long you're going to live, which means you're not going to know how much you're going to spend. So how do you really prepare for this? You can't go back. You can't really quit your job and then 20 years later go right back to it, start your career back and make the same amount of money. The stats are pretty scary. 45% of Americans will run out of money in retirement, even people who invested. So nearly half of Americans retiring at 65 risk running out of money. That is a lot. And single women face a 55% chance of depleting their funds, which is higher than single men and couples. I'm not sure why that is. Experts advise better tax planning, diversified investments to mitigate retirement risks. But it would be a very scary situation to do all that planning to retire, to be living your life, and then run out of money. So there are some things you can do to try and prevent this nightmare from happening.
Diversification. You want to have a diversified portfolio. This way, not all of the assets that you're invested in are going to move in the same direction, especially when that direction is downwards. What does diversification look like? Well, it could look like having a portfolio that's 60% stocks and let's say 40% bonds, or it could look like having some real estate or having some commodities or having some exposure to foreign stocks as well. And so as the economy changes, let's say we have high inflation or interest rates rise, certain asset classes will either go down or up. And so when you're diversified, you remove the risk of losing a lot of your portfolio. Invest regularly is the second tip. So a good way to do that is to set something in your account so that every month when you get your paycheck, it pulls a certain amount, whether it's $50 to $1,000, however much you think you can allocate, and that number will grow substantially over time. Think about it as money that you might invest in a pair of pants that you may throw away in a year. If you invest that in stocks, you'll see great returns. I'll give you an example. I had a source of mine that I interviewed that years ago was advised to buy shares of a company that he spends money at. And so for him, one of his favorite things to drink was Coca-Cola. And so he would invest $5 to $10 a week in Coca-Cola stock instead of just buying Coca-Cola. And when we looked at his account years later, when I was interviewing him to see what his retirement fund looked like, he didn't even realize that that investment grew to $50,000 just from those shares alone. Now, I'm not telling you to go and buy Coca-Cola stock, but what I am saying is something as little as $5 to $10 could be a really surprising amount years down the line. Tip number 3 is one that a lot of people can overlook because it's often in a fine print of a fund that you're investing in, and that's the fees that come with these funds. And those fees can look really small at first, anything from 0.02% to 1%, but in the long run, that variation could have a huge difference in how much a fund can cost you. Let's say you have a fund that costs or has fees of almost 1%, depending on how much you've invested and for how long, that cost could amount to 6 figures from your retirement account. You really need to pay attention to that. But at the end of the day, if you don't have an option to have access to a low fee fund, let's say because your 401k has limited options, it's still better to invest, even if the fees are a little higher, rather than not invest.
Being diversified, investing regularly, paying attention to fees. These are some big things. You always want to be diversified. You never want to put too much money into either one asset class, one sector of the economy, and certainly not one actual security, a stock or a commodity, a bond, a crypto, whatever it is you're putting your money in. You don't want to put too much in any one thing. Investing regularly, getting into that habit. Look, it doesn't matter if it's $100, 1,000, 10,000, just getting into the habit. This is something you want to start as early in life as possible. Get into the habit of investing that excess money you have every month into the market regularly. And fees. It's another big reason to educate yourself, because if you take all your money and you give it to somebody to handle for you professionally, they're going to charge you a lot of money in fees. And there's nothing on them to put you in the best investments. They can easily put you in the ones that pay them the biggest commissions, which is what a lot of financial advisors do. So you want to be educated. I like ETFs. Fees are very low, exchange traded funds, versus individual stocks. Now, there are no fees in individual stocks, but there is a lot of risk.
You want to avoid the concentrated risk that comes with investing in individual stocks. I know that can be an eye roller, but in reality, it's really risky when you're investing in single companies as a big chunk of your portfolio. Imagine a hedge fund manager or even a fund manager. They spend hours on end and they have a whole team that looks into individual stocks and their earnings releases, and even they don't get it right. So imagine the disadvantage that a retail investor could be at when the majority of their portfolio, or a big chunk of it, is concentrated in investing in individual stocks.
So you always want to watch your risk. You want to take as little risk as possible, but still try and maximize your returns. Now, there is one more thing you can do to try and prevent yourself from ever running out of money in retirement, and that is watching your spending. After retiring, most people's spending habits either remain the same or go up. This is interesting. A lot of people don't realize that when you have more leisure time on your hands, more money goes towards entertainment and travel, especially in the first few years, and the outcome is a higher withdrawal rate. You're pulling more money out, which may actually push you into a higher tax bracket, which is even worse because now you're paying more money to the government. So people spend their careers investing in things like their 401ks, their individual retirement accounts, because they allow contributions before taxes. It sounds like a great perk because you can cut taxes and defer them. But the downside is that when you pull that money out, they will be taxed. Now, if you have a Roth IRA, you won't be taxed when you pull money out, and that's because you already pay tax on it when you put it in. Paying attention to taxes is important, but I really think watching your spending is even more important, because people sort of assume when they retire that they'll have free time, they can do whatever they want, but you're going to need to fill the time. I mean, you're not dead. You stopped working. Okay, I stopped working. Do I look like I'm dead to you? I'm very much alive, baby. A friend of mine is thinking about retiring. He's probably, I don't know, maybe late 60s, he might be 70 by now. I really don't know, but he's thinking about retiring. And him and his wife, they spend a lot of money. They travel a lot. They go all over the world, international trips. And usually when they fly first class. They spend money. And I remember thinking, like, if you're going to retire, I mean, you're probably going to do more of that. And if you do more of that, you're going to be spending more and more money. Remember, when you stop working, you now have that 8 hours of the day you're used to spending at some job open and free. That doesn't mean you're always going to be sitting around or going for a walk or doing whatever. It does mean you might be spending money, going out to eat more, traveling. That's the big one. Traveling sounds great, and I'm sure it is, but it does cost a lot of money. So you're going to be filling those hours of the day, weeks, months with things that are probably going to cost you more money. So you want to be prepared for that. Watch your expenses. What is it that you're going to do? Are you going to start a whole new life? Are you going to volunteer? Are you going to maybe work part-time? If you're not working at all, are you going to have a hobby? Is it going to cost you money? You need to think about all these things before you actually take the plunge, because that way it'll minimize your risk of the scariest thing, which is you retire and you run out of money. Let me know what you guys think. Like and subscribe to the channel, add a comment below, and I'll see you guys next time.